Right now, the retail market is treating every new tech and defense listing like a one-way rocket ship. You're seeing massive surges in early interest and a relentless upward momentum that makes it feel like you're missing out if you aren't already on board. That brings us to the 650 crore rupee Kusumgar IPO. The hype around this launch is deafening, but when you look under the hood, there is a massive structural disconnect between the excitement you're seeing on the surface and the actual mathematical reality of the business. You'll hear a lot about the gray market premium, or GMP. That's the unofficial pre-listing price indicator that traders use to gauge demand. Kusumgar is boasting a 40% GMP, which sounds incredible at first glance. Look at this chart. The left shows that tempting 40% GMP, but the right reveals a towering 43 to 45 times PE multiple. Expanding this, lower blue bars represent peers Garware and Toray. Kusumgar demands a massive premium over battle-tested companies. When you pay a multiple that high, you are pricing in absolute perfection. You leave yourself with zero margin of safety. If Kusumgar's growth stalls even slightly over the next few quarters, that premium valuation collapses. Relying solely on a short-term 40% premium signal while ignoring a bloated valuation is a classic trap. You end up paying top dollar for an unproven future. The price tag is only the first issue. To understand a company's true motives during an IPO, you need to look past the valuation and track exactly how the raised money will be distributed. There are two main ways IPO capital is used. A company can issue fresh shares to build new factories, hire talent, and grow. Or they can execute an offer for sale, where the capital raised goes directly to paying off existing owners who want to sell their shares. This brings us to a major red flag. This diagram maps Kusumgar's 650 crore IPO fund. It's a 100% offer for sale. Every single rupee flows directly out of the central pot into the pockets of early shareholders cashing out. Notice this second grayed-out pathway. Absolutely zero new capital is being added to Kusumgar's balance sheet. They get nothing to fund future research, expand operations, or reduce debt. Think about what that means for you. By buying into a 100% offer for sale, retail investors absorb all the future execution risk, while the company itself gets zero new financial ammunition to actually succeed. That lack of new funding is especially concerning when you look at how Kusumgar actually makes its money. Historically, they built their high profit margins supplying specialized fabrics for the aerospace and defense sectors, specifically materials for parachutes. But modern military tactics on the ground are shifting rapidly. Autonomous unmanned aerial vehicles, commonly known as drones, are quickly replacing traditional manned military parachute deployments. This chart translates that technological shift directly into Kusumgar's financials. Because of the rise of drones, nearly 55% of their core segmental revenue in aerospace and defense is experiencing a sharp projected downward trajectory. Facing a shrinking core market, the company is attempting a hard pivot to survive. They are trying to transition away from specialized aerospace materials and expand into fabrics for the outdoor, lifestyle, and automotive markets. The problem is the terrain they are entering. Unlike their highly specialized defense niche, the lifestyle fabric space is notoriously fragmented and brutally competitive. They are relying heavily on industrial and automotive expansion to replace their dying parachute business. But without an established, dominant moat in these new sectors, it is highly questionable whether they can maintain their historical profit margins. Add it all up, you are being asked to pay a 45 times earnings premium for a company that is actively downgrading its business model, trading a high-margin, specialized legacy moat for a low-margin, highly contested battleground. So where does this leave your capital? The trade-off here is stark. Kusumgar has enough momentum to offer a high probability of a quick listing pop, but it carries a severe risk of long-term structural deterioration. Let's look at this decision tree flowchart to break down your options. You need to strictly categorize your objective into one of two paths. Are you looking for a long-term hold, or are you trying to flip this for listing gains? If you follow the left path as a long-term investor, the math makes the decision for you. With a 45 times PE multiple, declining aerospace revenues, and a 100% offer for sale, the core play is far too risky. This is a clear pass. If you follow the right path to capitalize on that 40% gray market premium, patience is your best tool. You need to wait and monitor the institutional demand, specifically on day 3 of Mobire, or QIB numbers, on July 10th. If big institutional money is still pouring in despite the red flags we've discussed, a short-term momentum play is viable, and you can apply. But if you take that route, set a strict stop loss. If market sentiment shifts unexpectedly before opening day, the momentum will vanish. The absolute worst-case scenario is getting permanently trapped holding a weak asset because you tried to make a quick trade. At the end of the day, successful investing means separating market hype from mathematical reality. Look closely at the numbers, weigh the structural red flags, and make sure your capital deployment aligns entirely with your actual risk tolerance.
If you like our video, please like, share, and subscribe.